Welcome to our video on investing in hedge funds, opportunities and risks. In this video, we will explore the world of hedge funds, their investment strategies, and the potential risks and rewards of investing in them. Hedge funds are private investment funds that are typically available only to accredited investors. These funds are managed by professional fund managers who use a variety of investment strategies to generate returns for their investors. The hedge fund industry has grown significantly over the past few decades, with assets under management reaching over $3 trillion in 2020. Hedge funds are popular among high net worth individuals and institutional investors who are looking for alternative investment opportunities that can provide higher returns than traditional investments. However, investing in hedge funds is not without risks. In this video, we will explore the opportunities and risks associated with investing in hedge funds. So, let's dive in and explore the world of hedge funds. Hedge funds use a variety of investment strategies to generate returns for their investors. These strategies can be broadly classified into four categories: directional, relative value, event-driven, and tactical. Directional strategies involve taking long or short positions in assets based on a fund manager's view of the market. These strategies can be further classified into equity long/short, global macro, and managed futures. Equity long/short strategies involve taking long positions in undervalued stocks and short positions in overvalued stocks. This strategy aims to generate returns by exploiting market inefficiencies. Global macro strategies involve taking positions in currencies, commodities, and other assets based on the fund manager's view of the global economy. This strategy aims to generate returns by predicting macroeconomic trends. Managed futures strategies involve taking positions in futures contracts based on a fund manager's view of the market. This strategy aims to generate returns by exploiting trends in commodity and financial markets. Relative value strategies involve taking long and short positions in related assets to exploit price discrepancies. These strategies can be further classified into fixed income arbitrage, convertible arbitrage, and statistical arbitrage. Fixed income arbitrage strategies involve taking long and short positions in fixed income securities to exploit price discrepancies. This strategy aims to generate returns by exploiting market inefficiencies in the fixed income market. Convertible arbitrage strategies involve taking long positions in convertible bonds and short positions in the underlying equity. This strategy aims to generate returns by exploiting price discrepancies between the convertible bond and the underlying equity. Statistical arbitrage strategies involve taking long and short positions in related assets based on statistical models. This strategy aims to generate returns by exploiting price discrepancies that are not related to the underlying fundamentals of the assets. Event-driven strategies involve taking positions in assets based on corporate events such as mergers, acquisitions, and bankruptcies. These strategies can be further classified into merger arbitrage, distressed debt, and special situations. Merger arbitrage strategies involve taking long and short positions in companies involved in a merger or acquisition. This strategy aims to generate returns by exploiting price discrepancies between the target company's stock price and the offer price. Distressed debt strategies involve taking positions in the debt of companies that are in financial distress. This strategy aims to generate returns by exploiting price discrepancies between the distressed debt and the underlying assets of the company. Special situation strategies involve taking positions in assets based on special situations such as spin-offs, restructurings, and share buybacks. This strategy aims to generate returns by exploiting price discrepancies that arise from these special situations. Tactical strategies involve taking positions in assets based on short-term market trends. These strategies can be further classified into short-term trading, high-frequency trading, and quantitative trading. Short-term trading strategies involve taking positions in assets based on short-term market trends. This strategy aims to generate returns by exploiting short-term price movements in the market. High-frequency trading strategies involve using computer algorithms to trade assets at high speeds. This strategy aims to generate returns by exploiting small price discrepancies that arise from market inefficiencies. Quantitative trading strategies involve using mathematical models to trade assets. This strategy aims to generate returns by exploiting price discrepancies that arise from market inefficiencies. So, these are the different investment strategies used by hedge funds. In the next segment, we will explore the potential risks and rewards of investing in hedge funds. Hedge funds offer potential rewards to investors who are willing to take on the associated risks. These rewards include higher returns, diversification, and access to alternative investment opportunities. Hedge funds have historically provided higher returns than traditional investments such as stocks and bonds. This is because hedge funds use a variety of investment strategies that are not available to traditional investors. Hedge funds also provide diversification benefits to investors. This is because hedge funds invest in a variety of assets that are not correlated with traditional investments. This means that hedge funds can help investors reduce their overall portfolio risk by providing diversification benefits. Hedge funds also provide access to alternative investment opportunities that are not available to traditional investors. These opportunities include investments in private equity, real estate, and other alternative assets. Hedge funds can also provide access to specialized investment strategies such as short selling, leverage, and derivatives trading. These strategies can provide higher returns than traditional investments, but also come with higher risks. So, these are some of the potential rewards of investing in hedge funds. In the next segment, we will explore the potential risks associated with investing in hedge funds. While hedge funds offer potential rewards to investors, they also come with potential risks. These risks include high fees, lack of transparency, and the potential for significant losses. Hedge funds typically charge high fees, including management fees and performance fees. These fees can significantly reduce the returns that investors receive. Hedge funds also lack transparency, which can make it difficult for investors to understand the risks associated with their investments. This lack of transparency can also make it difficult for investors to monitor the performance of their investments. Hedge funds also have a history of underperforming compared to traditional investments such as stocks and bonds. This means that investors who invest in hedge funds may not receive the returns that they expect. Hedge funds also come with the potential for significant losses. This is because hedge funds use a variety of investment strategies that come with higher risks than traditional investments. For example, in 2008, many hedge funds experienced significant losses due to the global financial crisis. This means that investors who invest in hedge funds need to be prepared for the potential for significant losses. However, hedge funds also employ risk management strategies to mitigate these risks. These strategies include diversification, hedging, and risk monitoring. So, while hedge funds come with potential risks, they also employ risk management strategies to mitigate these risks. In the next segment, we will explore the factors that investors should consider when investing in hedge funds. When considering investing in hedge funds, there are several factors that investors should consider. These factors include the fund's investment strategy, the fund manager's track record, the fund's fees, and the fund's risk management strategies. Investors should consider the fund's investment strategy and whether it aligns with their investment goals and risk tolerance. Investors should also consider the fund manager's track record and whether they have a history of generating consistent returns. Investors should also consider the fund's fees and whether they are reasonable compared to the potential returns. Investors should also consider the fund's risk management strategies and whether they are adequate to mitigate the risks associated with the fund's investment strategy. Investors should also consider the fund's liquidity and whether they can easily redeem their investments if needed. Investors should also consider the fund's transparency and whether they have access to information about the fund's investments and performance. Finally, investors should consider their overall investment portfolio and whether investing in hedge funds aligns with their overall investment strategy and risk tolerance. So, these are the factors that investors should consider when investing in hedge funds. While hedge funds offer potential rewards, they also come with potential risks. Investors should carefully consider these risks and rewards before investing in hedge funds. Thank you for watching our video on investing in hedge funds, opportunities, and risks. We hope that this video has provided you with valuable insights into the world of hedge funds.